In this lesson, we address the issue of how does a board develop a budget? As an initial point, it should be said that most boards do not have people on them that have a high degree of talent or desire to plan a budget. So the organization does need to rely on those within the organization with financial expertise, such as the chief financial officer, sometimes with the title of treasurer, to oversee this aspect of it and then have the board intelligently review that and on the basis of that knowledge approve the budget, because ultimately it is the board's budget, so it must know that what it's producing is a reasonable representation of what can be expected the following year. It's also the most significant guidance that the board gives to day-to-day operations. Approved budgets mean essentially that the staff will not depart from it without the board's approval, although you've got to allow for some unexpected situations like emergencies to come up. But the board needs to know what it is doing with the budget, and we've got some basic plans on how this can be done that is well within the ability of competent board members, even if they don't have an accounting background. As we've discussed in earlier lessons, the last two board meetings of the year before the new fiscal year begins are ones where the budget is an issue. So if your fiscal year ends on December 31st and the board meets in the first month of each quarter, that means that the first of those meetings, the budget planning meeting, is going to be in July, and the actual meeting at which the budget is approved is in October. That's very early. Only halfway through the fiscal year, you're already making plans on what will be in the next year's meeting. That can be done. It's never too early to start planning on what the future finances will look like. But if that is the case, if you have meetings in the first month of each quarter, you probably want to schedule one after October just to verify everything that needs to be done before the new year begins, because surprises may happen in those last 3 months of the year. So the board should be working on its aspect of reviewing and approving the budget fairly early on in the process. At the early of those meetings, have the staff, generally the president and the CFO, present the issues that they expect to see as major issues in the coming year. Is there a major gift coming through? If so, and that's been promised, the budget expenses may go up to account for that. If there are significant repair costs, such as a building needs new safety construction, then the costs will be higher. This should be discussed by the board at the second to the last meeting. If inflation is going to be higher than anticipated based upon reports coming out now, that can impact lots of aspects of the budget coming up. This is a time for the board to generally give input on their concerns. They don't necessarily have to pass a motion for this. It could be sufficient just to have members of the board talk about areas where they disagree with the plan or think that extra caution should be taken, to give general advice so that the officers, particularly the financial officers, can put in hours of planning without a high risk that at the meeting where the board approves it, somebody says, I don't like this at all, change everything. That's a waste of everybody's time. So far better to have your second to last board meeting be thorough planning, discuss all the key issues in which there may be some kind of disagreement, so that when the final budget is presented for approval after hours of work by the chief officers, then it may pass with just minor modifications because the board will not be surprised. So avoid surprises at that last meeting by having the second to last meeting be one for planning. When carrying out budgeting for the next year, it pays to rely on an accountant. For a small organization, that may not be feasible because the costs are high, but there is a tremendous benefit when an organization has sufficient funds to do so, to rely upon those with expertise that are outside the organization to give objective advice and not just rely on those that are inside. Our best recommendation for planning the budget is to take the annual informational tax return tax return, that's IRS Form 990, and look at Section 8, which is the Statement of Revenue, and Section 9, the Statement of Functional Expenses, as your guideline. This will do your bookkeeper or accountant who completes the 990 a big favor. The categorization of revenues and expenses for charities and other tax-exempt entities is different in kind than it is for for-profit businesses and enterprises. If your budget follows the contours of the IRS's Form 990, that makes things a lot more easy to understand and brings a lot of clarity. A word of caution, don't hit the pause button on this to go look at Form 90 until you hear this, but the section on revenue in IRS Form 990 has 25 revenue lines and about 31 expense lines. However, most organizations do not have entries for every line. In fact, many of them fill out well under half of them. So don't be shocked when you look at the form and see how many lines are there. If you don't have any kind of gambling revenue from various bingo games or raffles, then you're not going to put anything in that line. And so also, not everything there is relevant to every organization, but those that are relevant are ones you want to include in the budget. We have another recommendation that is beneficial in having a budget prepared by staff that is useful to the board in determining expenses. We think that it is appropriate to have about 25 lines for expenses and maybe not quite as many for revenue sources, but possibly so. And a way to break this down is to consider that any expense of the top 25 expenses is worth noting on the budget. And with 25, if they were evenly divided, that would make up each of them 4% of the budget. So our recommendation is looking at last year's revenues or the current year's revenues and modified in light of the prior year, is look at any expenses that you have that are at least 4% of the total expected expenses and have those as an entry on the proposed budget for next year. If the expense is less than 4%, you don't necessarily need to break it out unless it's really a useful thing for the board to consider. Let me give an example of how this can work out. Suppose you've got an organization that does a lot of presentations at conventions. So they go to 5 conventions every year, and 2 of them are very expensive, and each makes up more than 4% of the board's budget, with a total expense of 12% of the board's budget spent on conventions between the 5 conventions. If one of those conventions every year is in Europe and another one is in Asia, it's easy to see how they can make up individually more than 4% of the budget. So break those out on the budget that's presented. Say conference in Europe, put that amount separately. Conference in Asia, break that out separately. If the other 3 combined only make up 4%, you really don't need to break them out individually. Just put other conventions, other domestic conventions, 4%, or the actual amount that makes up around 4%. This gives the board substantial information on what the major expenses are. This doesn't need to be followed rigidly, and there is no protocol mandating this, but in our experience, this is a very useful way for boards to learn about expenses, learn about revenue in the context of their organization, and make plans for the next year. It's also a great discipline for the managers of the organization to think through these issues and explain and rationalize, justify what they propose for the board to act on. And then the final product that the board works on is going to be a very, very useful thing. In the financial reports that are given to the board at every board meeting, there is never a reason why at a regularly scheduled board meeting you don't have a financial update. There is a method for planning on the report that could be extremely useful. A lot of CFOs don't think about it this way, and this could be a very useful thing in planning. The preparation for the meeting, and our recommendation is that written reports be given to the directors on a board at least 2 weeks before the board meeting. One of those reports in every situation should be from either the CFO or perhaps a combination between the CEO and the treasurer to let the board know how the organization is performing financially, since this is a key part of the audit function and the planning function. It is a useful exercise for the finance team to look at the 10 biggest deviations from the annual budget at the time they're preparing this report. It's possible that payroll is substantially lower than planned because a highly compensated employee left. Thus, we're bringing a significant lowering of expenses, although it may come with risk in other areas because you're understaffed. Similarly, in planning repairs, there may be an unanticipated roof repair emergency that brings up costs that had to be addressed before the board could be informed, but it leads to maintenance costs being 3 or 4 times as high as what was proposed in the budget. I would not recommend that the CFO just give a list of top 10 deviations, but rather use those as the key issues to be given in the narrative on the health of the organization. If the only reason that an organization is in the black is because 2 staff members left, that doesn't necessarily reflect great conservative operation. It actually may expose risk that could lead to greater expenses downstream. But a narrative explaining how the organization is doing can be given with much more clarity to the board if those planning on the report take into account what are the main deviations from it. And absolutely at every board meeting, one of the key activities is engagement with the financial team on how the finances are doing. And in a later meeting, we get into how important it is to provide that information in advance in writing. Don't surprise the board at the meeting with shocking information. Rather, it should be given ahead of time. And we'll get into that in a later lesson. Another aspect that I recommend, since we're talking about finances, is the annual tax return filed by tax-exempt entities, Form 990, is often prepared by accountants who don't necessarily have a substantial tax-exempt practice. That is, they may not be familiar with Form 990 by completing a lot of them. We do find in our role as counsel in this area a number of times when significant mistakes are made, and it's due to something that's not really the fault of the accountants, but the IRS seeks to oversee governance issues in Form 990. They want charities in particular to disclose a lot of information that really does not have a lot to do with finances. And it is easy for accountants who are more for-profit business oriented to not pay attention to these issues. One example of it is that Form 990 requires disclosure of the compensation for officers, directors, and key employees, a defined term in that form. The reason for this is not just to make sure that accounting balances, it's because the IRS is seeking to determine whether anybody is getting excess compensation. The way they monitor this is by having that information on Form 990. We find many accountants overlook that section, put zeros where they should put an amount down, and in an audit, that can tend to look very bad. So our recommendation is when the 990 is prepared, it should be done in sufficient time that the board gets to look at it. There's a checkoff box on Form 990 indicating that the Form 990 was distributed to the board before it was filed. Doing that requires a lot of advanced planning. But our recommendation is also have counsel take a look at that as well, just to make sure that you've got a second set of eyes from a slightly parallel discipline looking at it to make sure that it's accurate. And with that, budget planning can be done effectively. It's a big adjustment for an organization that has not done this before. But once the patterns and disciplines we talked about are put into practice, you'll find the whole budget process in coming years very, very easy to monitor.